Canberra, I'm back again, and today I'm going to talk to you about IRD. No, it's not a government organization. It actually stands for Interest Rate Differential. Now you may be asking, well, what the heck is that? Well, normally IRD doesn't matter as much, but now that we're living in a hyper low rate environment, it comes into play. Lenders basically, when they're figuring out your penalty for your mortgage, well, actually there's three types of penalties. Certain lenders have a restricted mortgage you may have signed on for at the beginning where the penalty is pretty clear. It could be 2-3% of whatever your principal is. So that's one type of penalty. Another one that a lot of folks are commonly familiar with is what's called 3 months interest. Pretty simple, easy as it sounds. If you are basically paying out your mortgage early, you're going to be basically paying as a bonus 3 months interest to the lender. Now, normally variable mortgages all come with 3 months interest unless you've got something, again, that's a little odd or unfamiliar. So those mortgages, when you're in a variable, always have a 3-month interest penalty. However, when you've got a fixed rate mortgage, that's where things get a little tricky. And it really depends on the lender you deal with in how complex it may become. So let's dive into this and we'll use a real example of what this would look like. All right, so now we're going to take a look at the math, and I'm going to have my little cheat sheet here because let's face it, math is confusing and I don't want to steer you on the wrong path. So let's begin. You took this mortgage out, let's say in December of 2019, and you started with $500,000. Now, at that time, the rates were 3.08% for a 5-year fixed term, and the posted rate, that's the rate the bank based their discount off of, was 5.34. So you basically got a discount of approximately 2.26%. That's the discount you started with, so keep that number in mind because we're going to need it later on. Now, you look at the rates and go, oh, it's insane out there. Rates are super low. I want one of these super low rates. Come on, let me pay this mortgage out. I'd like to get started. Okay, well, let's take a look at what that would look like. Now you're a year in, you've got 4 years left. First thing we're going to start looking at is what is the 4-year posted rate with TD? Well, the 4-year posted rate is 3.74%. Now, your original discount was 2.26%. So for IRD calculations, we're going to take that 3.74 minus the 2.26, which is going to give us a 1.48%. That's the rate the lender is going to say, hey, if you were to come back to us, that's the rate we would be offering you today. Now, we're going to take that number and we're going to figure out what your IRD difference is. Well, so remember, you've got a 3.08 less the 1.48. I know a lot of math here. 1.6 is the net difference. Okay, so that's the key number they're going to base your penalty on. Now, the next step of this calculation is we're going to take our balance, our 486,471, and we're going to times that by 0.016. That'll give us 7680 annually as a penalty difference. Oh, sorry, 7783. See, even I get this math wrong sometimes. 7783.54, and we're going to divide that over 12 months, which basically gives us 648.63 monthly. That is the monthly interest difference that the lender says, hey, we're losing by you paying us out early. So guess what? We need you to pay that money back. And so over the 4 years, the next 4 years, we're going to lose that money. You owe us $31,134. Not a small sum. And I can tell you that most of the phone calls I get when people want to find out about these lower rates, they only think of the 3 months interest. They say, hey, you know what? I want to pay this mortgage out and I figured out my own penalty, and 3 months interest on a mortgage that size would have been $37.46. I'd be super excited if that's all I had to pay out as well and get that new lower rate. So let's take a pause for a minute. So why would lenders not allow you to rampantly pay out mortgages like that? Well, think about it. Mortgages today are not like they used to be. Way back, it used to be that banks and stuff would have depositor funds on and they would lend your money to other people, and that's kind of how it functioned. But now we're in a very advanced world. Mortgages are sold off, they're securities, they're investment opportunities for investors. So investors, when they buy mortgage-backed securities, are buying a guaranteed return. So if you promised an investor 3.08 and now suddenly you say, hey, we're paying you out, and they lose that, they want to be compensated for it. Because if it wasn't, we'd have anarchy and nobody would lend money anymore. That's why. And the other reason is you wouldn't be too thrilled if the bank suddenly phoned you and you were paying, let's say, 1.5%, and they said, hey, you know what, Cam, rates have gone up. We're going to pay your mortgage out. We're going to start charging you 4%. You'd say, what? Exactly. So that's why that happens. All right, so let's take a look at what the implications of this were. Now, if the way to figure this out correctly and to see if this is worth doing or not is to look at flash forwarding 4 years and see where you would be if you took no action and if you took action. Because there is times that you still may want to do this regardless. But again, the key to figure out is, will you get any of that penalty back and what are things going to look like? Okay, so let's take a look at that. If you were to stay with the original mortgage at the end of the next 4 years by the maturity date, you would owe $482,027. That would be monthly payments of $2386.80, which total $114,566.40. Nice thing, you don't have to remember all of that because the figures are over there. Okay, so if you take out the new mortgage and we roll the penalty in, because let's face it, who has an extra $31,000 kicking around? That means that your new mortgage is $517,605. And over the next 4 years, making payments of $2135 per month, you're going to wind up paying $102,493. Basically, and owing $443,541 by the end. Okay, so a lot of numbers. What do they mean? Let's take a look. Basically, you make $12,073 less in payments by making the move versus leaving things as is. However, you will owe an extra $15,514 by making the move versus leaving things as is. So the net difference is you're going to owe $31,44.41 more at the end of the 4 years. Okay, but that's a lot less than the $31,000 penalty we started with. So basically, you're going to recover $28,000 of this penalty back. So now you would say, why would I do this? Well, a lot of times people do this for cash flow. They look at the lower monthly payment. That's what they're after. They say, hey, you know what? It's worth it. There could be a situation where you're getting divorced, something's happening, where you just have to pay this mortgage out. So there is a variety of reasons. The good news, however, is you will get a chunk of this money back. It's not all gone. However, the bad news is it's not all savings either, because that's the fallacy a lot of people have. If I pay this mortgage out, I'm going to save oodles and oodles of money. It's not. Now, if you were in that 3-month interest situation, 100%, you'd be saving nothing but money, and it would make total sense to do it. Now, what's the next steps? Well, if you would like us to have a look at your specific situation, we'd be happy to do so. At Auxilium, that's what we do. Another neat thing that you might not realize is that your current financial institution is by law forced to have online calculators that allow you to figure this out. So depending on the bank or institution you're with, go to their website, and I guarantee you that on their website they'll have a section for prepayment penalties and prepaying your mortgage out early. They're mandated to have these figures there. And the other thing to keep in mind is that if you're looking for the very best rates out there, typically they would be deemed to be called an insurable or an insured mortgage. In those situations, you cannot add any of your penalty to the actual mortgage that you're taking out. So it will have an impact on rates. All of this to say that this is quite confusing. That's why you need a professional to come in and kind of help out. Now, the other thing that just dawned on me is that we did a video earlier about cash back. The neat part is that you can actually use cash back to cover part of your penalty. So as you can see, lots of moving pieces, lots of reasons why you would want to call a professional, people like us perhaps at the Auxilium Mortgage team, people with hundreds of positive online reviews, which would give you a compelling reason to give us a call. There's no fake narratives here. We're all about being real and providing great service. So reach out to us. Hopefully this has made things a little easier to understand. I know nobody loves doing math, but this is the kind of math you need to know because it affects you financially, and let's face it, nobody should care more about your money and your financial well-being than you.